A building full of people who cannot leave. Rent that never goes unpaid because the tenant has no choice. A landlord with a captive market, backed by a government check. On paper, it looks like the safest income stream in the world. Then the occupancy rate drops by 11%. And a facility built to hold 2,000 people starts losing money on every single one of them. Welcome to the strangest hotel business on earth. One where empty rooms bankrupt you faster than full ones. The private prison industry runs on a single brutal irony. The business only survives when someone else fails first. A judge, a parole board, a policy shift, in a state capital hundreds of miles away. None of it is in the owner's control, and all of it decides whether the balance sheet holds. By the end of this, you'll understand why an industry built on guaranteed government contracts still manages to bankrupt some of the most sophisticated operators in American finance. Here's how deep this actually goes. At the smallest scale, entry looks almost bureaucratic. A single halfway house or work release center, licensed through a county government, costs somewhere between $1 and $4 million to acquire or convert from an existing building. Contracts here are short, usually 1 to 3 years, and renewal depends entirely on local politics, not performance. Margins are thin, sometimes under 5%. The real product isn't incarceration, it's paperwork compliance, and whoever survives the state audit cycle keeps the contract for another term. Move up, and the math changes completely. A regional detention facility, the kind that houses federal immigration detainees or state overflow populations, runs $20 to $60 million in acquisition and retrofit costs. These contracts come from state agencies, or U.S., Immigration and Customs Enforcement, and they include something the small operators never see, a guaranteed minimum population clause. The government promises to fill a set number of beds, or pay for them anyway. It sounds like insurance. It behaves more like a loan the state can quietly walk away from the moment public pressure builds. At the top, you're not running a facility anymore. You're running a portfolio. National operators manage 70, 80, sometimes over 100 facilities spread across a dozen states, financed through municipal bonds and real estate investment trust structures. Market capitalization for the two largest firms in this space has swung between $1 and $4 billion over the past 2 decades. At this scale, the product isn't a building. It's a financing instrument wrapped around a population count, sold to investors who have never set foot inside a single facility they own a piece of. At this tier, growth doesn't come from building more prisons. It comes from acquiring smaller regional operators outright, folding their contracts into a larger bond structure, and refinancing the combined debt at a lower rate than any single facility could secure on its own. Scale isn't a marketing word here. It's a financing tool, and the operators who master it can outlast a policy downturn that would sink a mid-market competitor within a single fiscal year. Now, for the part nobody explains on the earnings call, think of a private prison like an all-inclusive resort with only one guest type, and that guest never spends $1 on site. The entire revenue model rests on something called the per diem rate, a fixed daily payment, usually $40 to $200, paid by the contracting government for every person housed. Multiply that by the average daily population, a metric operators internally call ADP, and you get the top line. It looks like a hotel's revenue per available room model. It behaves nothing like one. Here's the contradiction that breaks new investors before they understand why. Fewer inmates should mean lower costs. It doesn't. Staffing, utilities, and debt service on the facility are fixed regardless of how many beds are filled. Drop below roughly 80% occupancy, and the per diem income no longer covers the fixed cost base. The company loses money for every bed that sits empty, the exact opposite of every other real estate model on the planet. A landlord wants tenants. A private prison operator needs a legal system to keep sending them, on schedule, in predictable volume, forever. There's a second metric that matters just as much. One investors rarely see mentioned outside internal memos. The liability reserve ratio, the percentage of revenue set aside against lawsuits, injury claims, and federal oversight penalties. In a well-run facility, it stays low. In a facility cutting corners on staffing to protect margin, it climbs fast enough to erase the profit the cost-cutting was supposed to create in the first place. Compare that to a conventional landlord who can renegotiate rent, evict a bad tenant, or sell the property whenever the local market turns unfavorable. None of those levers exist here. The population is set by courts hundreds of miles from the boardroom. The rate is fixed by a contract signed years earlier, And the building itself has almost no resale value outside the narrow list of buyers who also operate detention facilities. It is, in financial terms, one of the least liquid asset classes tied to one of the most volatile input variables in government policy. This is why the design of these facilities has nothing to do with comfort, and very little to do with security in the way most people assume, and everything to do with cost suppression per body. Open dormitory layouts replace individual cells wherever regulations allow, because they cut the required staff-to-inmate ratio nearly in half. Fewer guards per 100 inmates means fewer salaries, which means a thinner cost base against a shrinking or fluctuating per diem check. Lighting is chosen for the lowest maintenance cycle, not for behavioral calm, no matter what the brochure claims. Kitchens are centralized to serve the maximum population from a single contract vendor, locking facilities into food service deals that run for a decade or more and rarely get renegotiated, even as ingredient costs rise year over year. Underneath the concrete sits something even less visible: municipal bond debt, often structured over 30-year terms, secured against a projected occupancy rate that assumes the facility stays near full for 3 decades straight. That assumption is the actual product being sold to the bondholders, not incarceration. A population forecast, dressed up as infrastructure. Every corridor, every fence line, every camera placement in these facilities was chosen by someone running a spreadsheet, not a security consultant. The building isn't designed to hold people. It's designed to hold a specific number at the lowest possible cost per head indefinitely, without anyone outside the finance department noticing the difference. When the forecast is wrong, the collapse is fast and specific. Otter Creek Correctional Center in Kentucky was built and operated under exactly this kind of long-term financing bet. When the state agency it depended on pulled its contract following abuse investigations, the facility lost its primary revenue source almost overnight. The bond debt didn't disappear. It sat there, unpaid and unpayable, against a building with no tenants and no buyer willing to take on a structure built for one purpose only. This is capital structure failure in its purest form, leverage built for a future that policy changed out from under it without warning. Contrast that with Walnut Grove Youth Correctional Facility in Mississippi. The financing there was sound, the market wasn't. Understaffing, driven by the same cost suppression logic that defines the entire industry, led to violence rates severe enough that a federal judge eventually intervened directly in facility operations. The state terminated its contract not because the numbers failed, but because the operating model was fundamentally mismatched with what the population actually required to remain safe. Cutting guards to protect margin turned into losing the contract that generated the margin in the first place. 2 different collapses, same industry. One died from too much debt stacked against a fragile promise. The other died from cutting too close to the one cost that mattered most, until the cost came back as a courtroom order. So here's the equation, stripped down to what actually decides who survives. Net income equals per diem rate, multiplied by average daily population, multiplied by 365 days, minus the fixed cost base, minus the liability reserve that regulators increasingly demand operators carry. Run the real numbers across the publicly traded operators, and net margins have historically landed somewhere between 12 and 18% respectable, but nowhere near the fortress-like stability the pitch implies to first-time investors. Thomas Beasley, who co-founded Corrections Corporation of America in 1983, built the entire model on one insight: government agencies would rather pay a fixed daily rate to someone else than manage the liability themselves. That single realization turned a cost center most institutions were desperate to outsource into a multi-billion-dollar industry. The system was never built for the idealist who wants to fix incarceration, or the over-leveraged buyer chasing a guaranteed government check. It was built for operators who understand occupancy math better than the agencies writing their contracts and who never, ever forget that the real client isn't the person in the cell. It's the policy that keeps sending them.